Hey everybody, thanks for joining me today. Today I want to talk about a stock that I've been buying and I think they have a very bright future ahead of them, even though the last year or two have been very challenging and their stock has dipped this year. And that is Paramount Global, ticker symbol PARA. This is a global media company with four distinct groups of assets. So number one, they have their TV media, which comprises domestic and international broadcasting networks. Number two, they have the direct-to-consumer subscription video on demand, for example, Paramount Plus. Number three, they have Paramount Studios, which is a valuable content library and its associated 62-acre lot in Hollywood. And number four, they have Simon & Schuster, a leading publishing division. Now, it is important to note that they are trying to sell off their Simon & Schuster business. In fact, they had actually come to an agreement earlier on. A judge actually blocked that sale. Now, there was another sale that was announced to KKR for about $1.6 billion. So we'll see if it goes through or not. Paramount would really like to sell this piece of their business. So I think eventually they will. They just got to find the right player that the government will approve. But for right now, it looks like it's going to sell for about $1.6 billion. Paramount has very long-lasting roots in their industry, going back to 1914 when Paramount Pictures was established, and in 1928, CBS was created. In 2019, Viacom and CBS reunite. In 2021, Viacom CBS launches Paramount Plus. In 2022, Viacom CBS rebrands to Paramount. 2023 has been a hard year so far for Paramount, but 2022, they actually had a decent year. In fact, their global streaming subscribers grew about 38% year over year to about 77 million, and Paramount Plus subscribers grew about 70% year over year to about 56 million. Not only that, they had a number of different movies that actually did pretty well in the box office, including Scream, Jackass Forever, The Lost City, Sonic the Hedgehog 2, Top Gun, and Smile. The company owns well-known titles such as SpongeBob, Indiana Jones, Top Gun, Terminator, and much more. They also own networks such as Nickelodeon and Showtime. Keep in mind that Paramount owns CBS. Believe it or not, CBS finished the 2022 to 2023 as the most watched TV network, with highly watched shows like Yellowstone and Criminal Minds. Though 2022 was a decent year and the company saw some decent momentum going into 2023, the stock price has fallen quite a bit this year as momentum has slowed down and some of the financials have deteriorated. The stock price has gone from $19 about a year ago, got all the way up to about $25 in February 2023, and today it's trading all the way down to its lows of $11. This is a 40% drop year over year, and some of the big reasons why the stock has fallen, including cutting their dividend from 24 cents down to 5 cents. Some of the movies that they released this year did not do as well as they thought in the box office, including Transformers and the latest Mission Impossible movie. Higher interest rates have hurt the company. Their annual interest should come in around $800 million, which is going to hurt the bottom line. In addition, Paramount was very late in the game with investing into their streaming, so they had a lot of catch up to do over the last couple of years. So they've had to put a significant amount of money back into their business to improve their streaming services, which has significantly hurt their free cash flow. In fact, they've gone from a really free cash flow generating machine to negative free cash flow. Though the past few months have been tough for the company, I think the future looks very bright. The company is seeing a lot of momentum with their streaming service in particular. Q2 global total viewing hours increased 35% year over year on their streaming platforms. Q2 subscriber growth on their Paramount Plus platform grew 17 million year over year. Their Q2 revenue growth for streaming services grew 68%. You can also see their global DTC revenue has grown about 37% year over year. One of the knocks on streaming services in general, whether you're looking at Paramount or you're looking at Warner Brothers, Disney, and others, since they are all fighting with each other on trying to bring on as many consumers as possible, they've really set their prices very low to try to get additional consumers and viewers of their product. As you can see on this slide here, many of those streaming services are going to be going up substantially going into 2024. So you can see Disney Plus is going from $8 to $11. You can see Peacock is going from $6 to $12, and Paramount Plus is also going to be going from $6 to $12. So that means they are going to be doubling their amount of streaming service revenue going into 2024, which should really boost the revenue in their bottom line. Next up, let's take a look at a 10-year history for Paramount, but keep in mind in 2019, Viacom and CBS merged, so it's got to be skewing these numbers a little bit. But nonetheless, we're going to take a look at them. So enterprise value has gone from $38 billion down to about $7 billion today. Sales per share has gone from $23 to $45 here today. That's an increase of 7% per year, about 4% over the last 3 years. Earnings per share, free cash flow has seen significant fallout over the last couple of years, and that is mainly due with the business putting a lot of money back into the business, trying to build out their streaming services, which has been very well known. If you've been following Paramount, and the CEO has been very open, that was probably going to happen this year, but going into 2024, we should see a reversal of that and some nice momentum going into the future. Book value per share has gone from $16 to $34. That's a 7% increase over the last 10 years, about 9% over the last 3. Return on invested capital has averaged about 10% over the last 10 years, about 4% over the last 3. Now, if we switch and take a look at the balance sheet, these numbers are going to be a little skewed because of the free cash flow dip over the last couple of years. I typically like to be able to see that the company can pay off its long-term debt within 3 years. But since it's negative because of the free cash flow, that can be concerning. But if we look at debt to equity, it actually looks fairly healthy, being at 77% right now. I like to see at the very minimum under 100%, if possible under 75%. So they're kind of right within there, so I'm okay with that. And their current ratio is at 1.2, which tells me they have more current assets than current liabilities. Now, the market multiple has been extremely low for this company. On average, it's been around a 6 over the last 10 years, and it's been a 4 over the last 3 years. So the market obviously has not paid very much money into this company because they're not sure about streaming services and really the TV industry in general. But I personally think it could be a really good buying opportunity. Now, as far as gross margins go, they've gone from anywhere from 42% at the top end all the way down to about 33% on the bottom end. That's a 39% average over the last 10 years, 35% over the last 3. Now, their operating margins have been all the way up at 22%, down to 7%, but we should see this grow going into the future as they spend less money on streaming. And for operating margins, they've been anywhere from 22% all the way down to 7%, but we should see this increase over the next few years. Nonetheless, their 10-year average has been 17%, and their last 3 years has been at 10%. Next, let's take a look at what analysts think the company is going to do over the next 5 years. So I think sales is going to grow only 2%, going from roughly $30 billion in 2022 to roughly about $33.6 billion in 2027. Now, operating income is expected to grow around 5% from a $2.8 billion up to about $3.6 billion. Now, free cash flow is supposed to grow tremendously, but keep in mind that it was negative last year at $130 million. It's expected to be negative around $340 million this year, but then it's supposed to significantly grow after that as we see their Paramount Plus subscriptions go up into the future, and the internal spending is not going to be as high. So they think free cash flow is actually going to go up to about $2 billion in 2027. They also think cash from operations is also going to grow around 63% per year, and earnings per share is going to go up around 14% per year. So given that information, this is what I'm coming up with on my first valuation template. So this is a margin of safety calculator. I'm essentially trying to project out earnings per share over the next 5 years. So I think a normalized EPS for this company is around $1, and I think their growth is going to be around 14% per year, which calculates out to a buy price of around $18 a share. The next valuation template I want to take a look at is my discounted operating earnings model. So I'm trying to project out operating earnings over the next 5 years, discount it back today to get my net present value of future earnings. And then projecting out what I think an exit multiple for this company will be, I can figure out what the intrinsic share price of the stock is. So I think sales is going to grow a little higher than what analysts think it's going to grow. So again, analysts thought it was only 2% per year. I'm coming up with about 4% per year, going from about $30 billion last year to about $30 billion this year, then about 31.5 next year, then 33 billion in 2025, 34 billion in 2026, and 36 billion in 2027. Now, as far as operating margins for the company, I think they're going to be struggling a little bit over the next year and a half. So last year they're at 9.4%. I think it's going to drop to 6% this year, then 6.5% next year, so a little uptick, then 7%, 7.5%, and then land around 9% in 2027. Now, we've already seen that the market has not been willing to pay a decent multiple for this company. I don't think it's going to be at 4 like we've seen the last couple years. I think the market's going to be willing to pay around an 8, especially if they can show that they're growing operating margins after the dip this year. So I think a multiple of 8 is reasonable. Based on that, I get an intrinsic share price of $20 a share. Next valuation model I want to talk about is the 10 cap valuation model. This is a Phil Town valuation. If you follow him at all, he actually learned this from Warren Buffett, who talked about this in a past annual meeting for Berkshire. This is how he valued land to buy. So we're going to kind of do that similar thing here. So we're trying to figure out what operating earnings of the business is, and then from there, try to come up with a 10 cap value. So we don't want to pay more than 10 times what the operating cash flow of the business is going to be over the next 10 years. So I think free cash flow for this business is around $500 million a year. I think their tax provision is roughly around $500 million as well. So I come with a 10 cap valuation of $15. Next valuation template I want to talk about is my payback time calculator. This is another one of those Phil Town calculations. So essentially, we're trying to buy into a company and get our money back within 8 years based on the company's free cash flow. So again, I think free cash flow normalized for this company is around $500 million. I think the growth rate is around 25% per year, as even analysts think it's going to grow to around $2 billion in 2027. I think it's only going to be around $1.5 billion. So I'm actually tempering that a little bit. But even based on that information, I come with a payback time of 6 years, which indicates a buy right now. So let's summarize these valuation templates and calculations real quick. Again, before I get into this, the current stock price is $11. So the fair value I'm coming at based on my discount operating earnings model is $20 for the stock. If I have a 30% margin of safety, my buy price would be $14. The payback time suggests the buy price is $19. The 10 cap buy price is $15. My margin of safety calculator comes at $18. So it's been very rare that all of my intrinsic value calculator suggests it is a buy right now. And if you do not know how to value companies, I do offer that on my Patreon. I'll put a link down below. You can also get access to my Discord channel, and it's another way you can support the channel as well. Next up, let's take a look at return on investment, what I would expect to get from the stock based on today's stock price. So today's stock price is at $11. I would expect a return on investment of roughly 25% over the next 5 years. That's 25% per year. Now that is assuming sales is going to around 4% per year, operating income is going to around 3% per year, and the exit multiple for the company and what the market is willing to pay is going to be around an 8. Now they do currently pay a dividend right now. From an annual dividend per share basis, it's 21 cents, which is about 6%. So those are my thoughts about Paramount Global, ticker symbol PARA. I'd love to hear from you guys in the comment section. Do you like this stock? Do you not like this stock? What do you think about my valuations I come up with this company? With all 4 of those suggesting it is a buy right now. Thanks again for watching. If you haven't liked the video already, go ahead and do so now if we're on the way out. If you like this content, I encourage you to subscribe to my channel. Thanks again. I'll catch you on the other side. Take care and God bless.